Business of Property podcast. I'm Simon, and I've been investing in property for over 20 years. And if you're an active landlord or planning your next property investment, this podcast is for you. I hope you find this episode useful, and if you do, I would really appreciate it if you could tell a couple of other property people about the Business of Property podcast. This week, I'm going to expand on the first step in my New Year episode on setting yourself up for property management success in 2025. And that first step was, of course, doing your self-assessment tax return. So it's not very exciting. It's possibly not something that you might be looking forward to or enjoy doing, but it probably is an important thing to do. Certainly, if you have property in your personal name, then this is going to be very relevant. And it's really that part of the self-assessment tax return that I'm going to be talking through today. If you own all of your property in a limited company, then this episode is probably not very relevant for you, because I am going to be specifically talking about the property pages in a personal assessment, or a self-assessment tax return. Even if you have an accountant helping you out with your overall tax return, generally speaking, they still expect you to actually collect together your own property figures, your own sort of totals for your property, effectively doing the bookkeeping part of your property business. Obviously, it isn't true for all accountants, and the arrangement you have with your accountant may be different. You may not have an accountant at all. You may be doing the bookkeeping element of it, collecting things together, collecting information together, and actually then putting everything into your tax return and filling it all in and submitting it yourself. That is perfectly reasonable to do. If you do have an accountant, though, it can help having them there to answer questions and provide sort of clarification on some details. And there will be a couple of points where I do mention that could be useful to talk to an accountant, to ask questions and check the details. It may also be that they provide you a spreadsheet template to complete, sort of to collect together your property figures, to then provide to them, to then put into the tax return itself. If that's not the case, though, I am going to talk a little bit about possible spreadsheet layouts, and of course, PATMA, which could be another approach. So let's work out how we can actually do the property tax return ourselves, collecting the data for it, collecting the information for it, and putting that all together into a usable structure for your self-assessment tax return. First of all, I'm going to cover a couple of sort of general points about this. So the default assumption in a tax return is that you're working on a cash basis. And this means that you're considering income and expenses to occur when the money actually moves. So cash, well, it probably isn't cash these days, but when the money moves. The alternative would be considering a transaction to have happened when it is due. So the invoice date on an invoice you're given, or the date rent is due rather than the date rent is actually paid. However, for property on a UK tax return, the assumption is that you work on a cash basis, so you're working on when the money moves. And you can opt to work the other way on an accruals basis if you want, but the default is cash basis, and that's what I'm going to assume here. And that is what I would recommend probably working on for most landlords and most property businesses, because that's generally a bit simpler. A note also on finance costs. Now, you're generally thinking about mortgages when you're looking at finance costs, and they aren't anymore acceptable as sort of complete expenses. Instead, they are collected separately, and you do get a sort of tax credit of 20% against them added in or taken off when you look at it later on in the process, rather than being an expense with all your other expenses. But it is also important to say that when you're looking at mortgages and the costs for them, in this finance cost category, you can only include interest that you pay on that mortgage. If you have repayment mortgages at all and you're paying off capital, the capital element cannot be included could never be included as an expense in the past and can still not be included in the finance cost bit that is still allowable. You can include fees, though, in most situations. There are some mortgage fees and finance fees that may not be allowable. So again, this is one of those cases where you might need to check with an accountant to be sure what's actually allowable, what actually could be included. However, one thing to note on fees is that some of the fees you can include might not have actually ever left your bank account. So for example, a fee on a remortgage, you at the moment might be looking at a 3% or a 7% fee or something. There might be quite large amounts of money on larger mortgages. And that fee may well just be added to your mortgage balance. So you will never see that payment being made anywhere. That money won't leave your bank account. It'll just be added on to the debt that you owe. However, that fee is an allowable finance cost. Not an expense, I need to make sure I get the right words, but it is an allowable finance cost in that category, even though the money didn't actually leave your bank account. So you need to make sure you don't forget those. How are we going to record these things? As I mentioned earlier, I think you'll be set up for a simpler future if you use PATMA. I, of course, would say that, but I do think it really is true, and that certainly is the point of PATMA. That's the whole reason I created PATMA, to make life easier for people and simpler. There are lots of time-saving tools built into it, like automatic repeating expenses and a document inbox for receipts if you want to handle them that way, or invoices or what have you. And there's lots of other sort of bits and pieces along the way that will help with this. Of course, on an ongoing basis, you can use open banking as well, which makes it much, much simpler. Although if we're talking about filling in a historic tax return or historic details for a past tax year, then open banking doesn't really work, because you can only go back 90 days in open banking. But there are still lots of time-saving tools available in PATMA. However, I do realise that not everyone will want to use PATMA. Some people will want to use spreadsheets. They will be more comfortable with that, and that's what we want to go with. So in order to be sort of accessible and cover the principles for everyone, I'm going to be assuming spreadsheet use more than PATMA use. So as such, if you are using a spreadsheet, you will need some sort of structure to that spreadsheet to actually record the information. So there are lots of different ways you could do this. I'm just going to mention a couple that I've seen a number of times in the past. So one could be a sort of journal approach. So you create a table where each line is a transaction. And then you'd have columns for income, and then a number of columns for the expenses, covering all the different tax categories. And then for each line, you'd probably have a little description of what it was, the date, and you would put a number in one of the columns, either for income or the appropriate expense category. And then this means you can scroll back, you can see all the details, you can see all the dates, you can see what happened when, and you can obviously add up the appropriate columns to get the totals that you actually need at the end. Or another approach, which is sometimes a bit easier when you've got lots of repeating expenses, is where you would have a column per month in the year, and your tax categories would be across, they would be the rows. And this is, if you've got multiple properties, this is often not quite so good. Or if you do, you could have multiple tables, but then you have to sum up across the tables, which is a little more awkward, but you could do that. The sort of nice bit of this one is that if you know you've got rent of £800 every month, you can fill in that £800 going across the columns very quickly and easily. It does mean you haven't got the exact dates to go back to. It does mean you haven't got as much detail in some of the figures, but it can be a bit simpler, especially if you've got a smaller portfolio. So that's just a couple of spreadsheet ideas. There are lots of other ways you could do it, but that's just an idea to get you started. And of course, if you don't want to go through the effort of creating a spreadsheet, creating a layout, creating a template, working out how you want to structure it, of course, again, I would recommend using a software tool such as PATMA, where you don't have to worry about all of that. The structure, the guides, the processes are all built in for you. So if you are creating a spreadsheet though, and you've got to create those different tax categories, I thought I'd just run through what they are quickly. So the first is shown as rent, rates, insurance, ground rents, etc. Relatively self-explanatory. Next one, property repairs and maintenance. Again, pretty self-explanatory. Next one, non-residential property finance costs. Now, this only applies if you're looking at commercial property, i.e. non-residential, because residential property finance costs come separately. They're no longer an official expense, as I mentioned earlier. So maybe relevant, maybe not relevant for you, depending on what's in your portfolio. Next one, legal, management, and other professional fees. So this is your, as suggested, your lawyer's fees, your letting agent's fees, etc. Next one, costs of services provided, including wages. So this is if you have been provided any specific services from other individuals. Then last one is sort of in the main categories is just other allowable property expenses. Of course, that's pretty vague, and you obviously need to look up what's actually included and allow for in there. There is another one that's a bit later on in the form, which is cost of replacing domestic items for residential lettings only. This is another one that you need to look into, and you need to check whether some things might fit into property repairs and maintenance, or whether they might fit into cost of replacing domestic items. And there are different categories of items that do fit in each of those. And then, again, later on in the tax return form, there is, of course, residential property finance costs. And this is not in the general expenses category. It's shown as a field later on because it is treated very different. So now we have somewhere to record all of our details. Where are we going to get all this information from? Well, the main places are likely to be bank statements, maybe credit card statements if you've been buying items on there, mortgage statements, particularly important for picking up those fees if you've had remortgages or similar, and then just invoices and receipts that you may have from tradespeople or shops where you've been buying supplies or paint or I don't know, whatever it is you might be doing. And that's probably going to be pretty much everything. And then, of course, you're going to need to sort of work through these. And you really do need to have a methodical approach for working through them, starting with the oldest records probably, and mentioning the cash basis element of it. You're looking at when money moved, and you're looking at the tax year. And in this case, we're looking at 2023 to 2024. So we're starting on the 6th of April, 2023, and we're working through to the 5th of April, 2024. So anything that's within those dates, including those two dates, is within this tax year. And it's when, assuming using cash basis, when the money moved within those dates. So if we're starting with bank statements, of course, the same would apply for credit card statements and similar. But I generally like working from a statement as sort of my master document, because we want to make sure we don't have sort of expenses counted twice or anything. So we don't want to include the credit card transaction, but then also an invoice that we've got separately. So I will always treat one of them as a sort of master document, and that would be normally the bank statements or the credit card statements. This works very well these days because there's very little that's normally done in actual real physical cash. But of course, if you do have cash purchases in your stack of receipts, then you may need to allow for that as well, and allow for that not being in your sort of master statement you're working from. But assuming you are working from master statement, that's the approach I normally take. Start from the old estates, work through each item, each transaction in turn. You may well want to cross-reference to invoices or receipts in order to check what it was you were buying, which tax category it fits in, recording some extra details, especially if you're taking the journaling approach, or if you're entering these details into a system such as PATMA, you'll need those extra details. It may also be useful to record suppliers as well, so that you can look at that in future to find out where you got things from. And then as you enter each line, I would recommend ticking it off the bank statement or the credit card statement or whatever to show that you've recorded it, that's done. You don't need to worry about, or you can make sure you don't duplicate that. So a little extra note on choosing the appropriate expense tax categories. As I mentioned, this can be a bit of a minefield, and I think this is really where having an accountant on hand does help, and you can ask them to advise you for certain things which tax category they would fit into. There is a sort of general principle to be aware of on repairs these days, which is that if you're improving something, it's probably not allowed as a running expense, as in any of these tax categories that I've mentioned. Instead, it would count as a capital expense, which you could then potentially claim against your capital gains tax as when you sell the property. But if you're just replacing like for like, but obviously new or fixed or resolving whatever the issue is, but it's like for like, then that's generally okay as a running expense. But if you're upgrading it in any way, so the item is different, it's improved, it's better in some way, shape or form, then you may not be able to claim that, or at least all of that expense, as a simple expense. Of course, if you're not sure, seek professional advice, which this podcast is not. This is general guidance. This is not professional advice. So if you do need that, do seek that from an appropriately qualified person, and they can help you choose which tax category to put things into. So having recorded all of your rental property money, income and expenses, so you've got your rent receipts, you've got all your costs for gas safety certificates, for mortgages, for repairs, for letting agents, whatever it might be, you've got it all recorded, then it really is just a case of adding them all up. And of course, this can be done in a spreadsheet with a few formula to add up the columns or to add up the rows, depending on how you've got it set up. And you will want a total for each of the tax categories and, of course, the income. And once you've got those ready, it really is just a case of putting those figures into the correct boxes on the property tax pages of your tax return. There are quite a few other optional things you can fill in on the tax return, like possible adjustments and allowances, such as for electric charging points or free port allowances, whatever they might include. But in most cases, you probably won't need to worry about those. So there's quite a lot of boxes on the property pages that you probably won't fill in at all. There are also a couple of others that are required, like the number of rental properties and a few other bits and pieces like that. But generally speaking, for most people, there will be less than 10 numbers that you need to fill in on the property tax pages of your tax return for a standard buy-to-let or HMO portfolio. So as I mentioned, this can all be done in a spreadsheet. But I do think lots of it is easier with PATMA, especially if you maintain your records throughout the year. And of course, once you've done this for the last tax year, for 2023, 2024, you can then keep going and get things up to date. And then once you're up to date now, you can then enable open banking and you can really streamline the process going forwards with a tool like PATMA. And it only takes a few minutes to keep things updated each and every month. And then come April this year, crikey, 2025 already, then it will be much, much easier, much, much quicker to just click a button in PATMA and it will generate all the numbers for you. I do hope that you have found this little run through of putting together your property tax return useful. Please do remember this podcast is not tax advice. If you have any questions about exactly where to put numbers on your tax return or from expenses, etc., do seek professional advice. And that's it from me for this week. I hope your tax return completion goes well and you manage to get everything done well ahead of the deadline. And I will speak to you again next time.